explain what it means. Then I'll talk about my own investment process, a few useful tips, thoughts, quotes. I mentioned few books, few people you should follow, and so on. And then we'll wrap it up. I hope this agenda aligns with your interest. It'll be about 65 to 70 minutes, followed by Q&A. Should we start?
Yes, sir. Seems like people are putting thumbs up.
Yeah, okay. Yeah, I'm not actually getting screen, so yeah, I need some feedback in between. Thanks. Okay. So to begin with, we need to understand the nature of personal finance in the sense that concept of finance are universal. But when we talk about personal finance, the personal aspect is more prominent, which means how you apply those concepts to yourself, to your own needs and aspirations is of critical nature. Sorry? Okay. So basically, there are seven broad types of income, which you can see on screen. Earned, as we know, is the earned income, which is usually our income from salary. Then there is profit by selling any product or service, which is a trade type of income. Then there is interest earned when you keep money in bank or savings account, you get interest. You may also get income through rental, which is renting out the property, either commercial or uh, residential. So that becomes your rental income. Capital gains is when you invest in stocks and when those stocks appreciate in value. When you sell those, you get capital gains. Dividend is again related to equity investments, where as part of you being the shareholders, you get some dividend paid by the company. And the last one, which is rare or less common, which is royalty. So if you have some intellectual property, if you have something which you can claim, right, to have license, you can get royalty income. Now, why I'm mentioning these seven types is usually we will have one type of income as the prominent one, and you maybe one or two more as the side income or additional incomes, right? It's rare to have multiple combinations of this income, but if someone manages then I think that's a great way to build future. Here are some asset classes. So there is cash or cash related investment opportunities, which could be your savings account and liquid funds and so on. Then there is equity, where you invest in stocks. Either you are the majority shareholder or minority shareholder, and equity linked investment vehicles such as ETFs and mutual funds and so on. Then there is fixed income, which is bonds and other kinds of investment options. There is real estate, which is your physical real estate, or now we also have opportunities to invest in what is called as REIT, which is real estate funds, right? And the last one is commodities, be it gold, silver, and other kinds of commodities. So basically, these are some of the common asset classes where one can invest. Now, let's start why personal finance. What is the need for that, right? So, in my opinion, the secret of a life well lived is to be healthy, wealthy, and anonymous. The last part could be debatable because given my recluse nature, I think if I'm wealthy and anonymous, I'm good. Some of you, especially the younger ones, probably may not agree with the anonymous part. So health and wealth are the matters which are too important to be managed without expert advice, right? Having said that, you should also have a little bit knowledge about wealth in terms of fitness, nutrition, medicine, and you also need to have basic understanding of personal finance, right? Which is catering to your own wealth. Now, unfortunately, both are not taught formally or adequately in our schooling system. And the reason I'm calling it a schooling system and not education is we have excessive focus on exams and grades and those kind of things rather than the learning outcome. The other thing we need to keep in mind is income is temporary, expenses or costs are permanent, right? So the moment you are born, you will start incurring expenses. However, your income is going to be probably temporary. If your main source of income is going to be salary, at some point you will retire and that income will stop. Through other sources of income, you might have some longer period, but again, it is not probably perpetual, right? We'll discuss more about this when we talk about a concept called human capital versus financial capital and how you convert human capital into financial capital. Nobody has become super rich by just saving, right? So if you just keep on saving uh, money and keep it in a bank account, yes, it will probably compound at a smaller rate, but it will not make you rich, right? You need to have passive or non-linear income to actually build wealth, right? Or you need to have multiple sources of income which you invest wisely to create wealth. Okay. I'll be quoting few people during the course of this session. One of them is this person, Naval Ravikant. I highly recommend you follow him. Uh, he put it well when he said that you'll never get rich by renting your time. So when you are doing any kind of job, what you are actually doing is you are renting your time, right? X number of hours per month, and you get paid for that. So that's a non-scalable kind of income. Okay. So let's start with basic terms. Now I just need feedback if we should pause at each section or do you want to handle all the queries in the end? How should we go about it? Is it okay if we complete the entire session? Sorry? Okay, I think let's continue with the session. We can handle questions and answers towards the end. So let's start with basic terms. So the first and foremost, I think the most critical term or concept to understand is compounding, particularly power of compounding, right? Now, this is not something fancy. We have all learned this in our school level mathematics, right? But the way we appreciate this is probably something we need to focus on in this session. So Einstein actually said compound interest is eighth wonder of the world. He who understands it earns it. He who doesn't pays it. And the reason it is very difficult to understand is it involves exponential function, which by nature is not very intuitive for humans. I'll explain through a few examples what I mean by that. So here is the simple formula. I think we all are aware of this formula that amount is equal to principal multiplied by 1 plus rate of interest raised to the power n, right? I hope everybody is kind of familiar with this formula. So to increase A, we have three possibilities, right? Either start with bigger capital, which is your P component, earn a higher rate of return, which is I, or have a long-term view, which is N. Now, having bigger capital, initial capital is a luxury. So we cannot assume that we always have large initial capital. Between I and N, what usually happens is we focus more on I. We want to have higher rate of return and we ignore N. And actually, N, the long-term tenure is the compounding effect, right? Which actually generates wealth. So the key lesson here is start early and be consistent. Let's deep dive more on compounding and why it is difficult to implement. So first of all, it works only in long term, right? Which means you need to show delayed gratification, which means benefits will come towards the end, right? So you should not interrupt compounding, only then you'll have sizable benefits towards the end. Now, that is something which is very difficult to practice. You probably might have heard the story of a king and a beggar uh, who asked for his reward for as rice grains. And beggar said that on a chessboard, 8 by 8 chessboard, just place one grain on first square and then keep on doubling it till square number 64, and that's the rice I want to have, right? And king grossly underestimated it and said that okay, it's easy, wish granted, right? What he did not realize was the amount it uh, becomes, right, after compounding for 64 times is 180 plus billion metric tons, right? Which is equal to 350 times of global annual production of rice. So it's enormous amount which usually we cannot grasp, right? Here is one more interesting example. If we were to play a game, right? You pay me 1 rupee on one day, right? And then keep on doubling that amount for every day for 1 month. And in return, I'll pay you 1 crore rupee per day, right? I'm not sure how many will take that bet. So let me increase the stakes. I can pay you 2 crore rupees per day, right? For 1 month, 31 days. If you calculate that, it looks something like this, right? So the amount which you start from rupee one and then keep on doubling at the end of 31st day, if you count all of them together, it becomes 214 crore, right? As opposed to the amount which I would end up paying, probably 30 crores or 60 crores, right? Now, what you need to see here is the amount actually really becomes big in last 8 or 10 days. Till date 20 or date 21, it is just 10 lakhs, right? And that's what I meant by you need to show delayed gratification and it works only in long term, right? So if you put it on graph, it looks something like this. This is classical exponential curve, how the doubling or any kind of exponential function looks. So if you see, it is hardly noticeable. There is hardly a dot which you can visualize, but there are tremendous gains towards end. Now, why this is significant is we often talk about Warren Buffett, who has compounded his wealth over last 60 years at the rate of about 19 to 20%, and his personal wealth actually mimics that graph which we saw earlier, right? So if you see, he's now 95 years old, still healthy and active, and more than 100 and I think 10 or 15 billion dollars, right? So this is exactly the exponential curve which I was talking about earlier. Right? So let's go back to the three avenues we initially saw for compounding. Start with bigger initial capital, have a higher rate of compounding, and have a long-term view, right? Now, higher rate of compounding, if you can get consistently, nothing like that. But even the smartest of the investors have not actually earned more than 15 or 18% of CAGR, compounded annual growth rate, over a long period of time, right? But that kind of rate is sufficient to build enormous wealth if you have a long time horizon. So here is one interesting example. This is a race between a bike, a car, and an aeroplane, right? Now, obviously, you would know who will be the winner, but let's see how the race proceeds and let's try to understand what are the learnings from it. It's about 1 minute or less. So let's see this clip. Okay. So let's try to relate this with the earlier compounding example that we're seeing. There were three possibilities to actually win this race. The first one was to start ahead, right? Which is in equivalent to having a bigger capital to invest, right? Which is not always possible in a fair competition. The second way was to accelerate fast, which means have a higher rate of compounding, which you actually saw in case of bike. So as the race started, bike was the first to kind of race ahead for a short amount of time, right? But the eventual winner was the vehicle with which has a higher, longer runway, right? Which is equivalent to the long-term view, right? So I think there are a lot of key takeaways from this example, not just related to uh, finance per se, right? Another example could be we often see that uh, we have peers, right? School friends, classmates, colleagues, right? Who we work with. And somehow some of the people manage to get far ahead in their career. And we wonder why, right? What we need to appreciate is probably they had a different kind of engine, different kind of uh, capacity, intrinsic capacity, which took them far ahead, right? So I thought this example was good to explain the concept of compounding. Now, a couple of more examples why our mind cannot grasp uh, exponential function. So we all know what a million, a billion, and a trillion is. Million is thousand times thousand. Billion is again thousand times million, and trillion is thousand times billion. Right. So it's a scale of thousand times. Right. But the question is, do we understand what enormous amounts these are? Right. So, for example, if we get paid $1 per second, how long will it take to be a millionaire, right? Which means essentially how many seconds there are in a million. So the answer here is it will take about 11.57 days for you to become a millionaire if you get $1 per second. If we extend that further and continue the same experiment, for you to become billionaire, it will take 31.7 years, right, to reach $1 billion. And for $1 trillion, it will take 31,700 years to reach $1 trillion. Okay. I hope everybody is with me so far. Now comes the interesting revelation of exponential function, right? Now I'll just tweak the initial proposition and say that what if that initial $1 doubles every second, right? What will the duration look like for these three? Okay. And you will be surprised to see the results. I think by your wildest imagination, you might not have thought of these numbers, but it will take only 20 seconds to reach $1 million, 30 seconds and 40 seconds to reach 1 billion and $1 trillion, right? So what would have taken 31,700 years without compounding, if we add compounding doubling effect every second, it falls down to just 40 seconds. That's the kind of effect the exponential function has. Okay. So moving on to the next set of concepts. Usually in investment, what are we actually trying to do, right? What is the core problem statement, even if we don't put it in that manner? The problem statement is very simple. It is to be wealthy before we grow old, right? We have a finite lifespan to work and earn income, and we want to become wealthy during that period. This also applies to nations, which we refer to as demographic dividend. My mistake there. Demographic dividend. So India, as we know, is very young country, and we have huge advantage of demographic dividend, which will last for about 25, 30 years more, right? After that, will become aging population, average age of Indians.
Sir, I'm sorry to
Yeah,
interrupt you.
yeah.
Uh, Due to Zoom constraints, I think the meeting will end soon.
Okay,
However, I'll put up another link on chat. Is it possible if we continue there?
sure, sure. Immediately?
Uh, it should probably end in 1 minute, so I
Sure,
think
sure. Yeah.
we can just continue that slide on that link.
Yeah, yeah. Thanks.
I request everyone to join the link that I've shared in the chat. I'm also putting it up
I
on
can't
the.
see anything. I can't see anything in chat yet.
Okay, yeah. It should be there now. I'm also sharing it on the group, and
Okay. I'll leave from here and join there.
yeah, thank you.
Thank you. Long will it take to double your investment? So, for example, 72 divided by rate of return will give you approximate time duration for doubling your investment. So, if your rate of return is 8%, it will take you 9 years to double the investment. Right now, you can also flip this equation and ask, if you want your investment to double in 5 years, what should be the rate of return? Right. So, what will the answer in this case? It will be 72 divided by 5, which is 14.4. Right. So when I was kid, in early 90s, mid 90s, there used to be government schemes such as Kisan Vikas Patra or Indira Vikas Patra and so on, whereby your money would double every 5 years. So what was the implied rate of return in those investments? It was 14.4 or 15%. Right. Now, if you see, the interest rates are down to 6%, 7%, which means it will take 12 years or 10 years for your money to double. With 2%, it would take 36 years. And with 1%, you will actually have to wait 7 to 72 years for doubling your investment. Now, why this is significant is, by controlling interest rate, you can, not you, the central bank can drive money away from fixed deposit or towards fixed deposit, right? If you see any developed nations, the rate of interest over there is pretty low, and that is one of the reasons why people are forced either to invest their money in capital markets, which is equity and other kind of investments, or to consume more, because it doesn't make sense to keep that money in bank with negligible returns, right? So this, I think, is very important, rule of 72, in understanding how monetary policy works, or how we are incentivized to invest in a particular way. Let's continue that discussion. So if one could understand a single thing about future, right, I would say that understanding or knowing interest rates for next 100 years would be the most important thing to grasp, right, for any kind of investment decisions or even valuations, because all valuations are a function of discounting, which is based on the interest rates. So here is a view of long-term interest rates in India from 1996 to 2022. So as I was saying, if you see this period, this is early 90s to mid 90s, the rate of interest was 14% or more, which means your money was doubling every 5 years. Then it dropped to this level in 2004, and then it again kept on fluctuating, right? What you have to appreciate is, it is not that this is one way trajectory. Depending on economic cycles, depending on uh, other events, this will fluctuate, right? But there is a definite trajectory, in the sense that it is coming down over the years. So the question for you is, what would be the interest rate in, let's say, 2050, right? Even in ballpark range, will it be 10% of more? Will it be in the range of 4 to 7 as they are now, or will it be similar to developed nations that we have 0 to 2% kind of rates, right? Now, if you could answer this, lot of your investment decisions, your valuation decisions would be settled, right? The problem is, it is not easy to, or it's not possible to predict the interest rate curve. And this is true not only for a developing country like ours, it is also true for developed nations, right? So here is a graph of 200 years of interest rates in US, right? As you can see, even in US, interest rates have been fluctuating. uh, in early 80s, when uh, inflation was very high, interest rates were more than 15%, right? And they have bottomed now since last many years, but you can see that those have been fluctuating. Okay. Now, what is the significance of interest rate? Let's say you want to earn annual interest of interest income of $100, right? Interest rate will determine what should be the initial capital you need to achieve that goal of $100. So if interest rate is 10%, $1,000 will suffice. Okay. But if interest rate is 1%, you will need $10,000. So for the same amount, you will need a huge capital at this lower interest rate, right? So that's an important learning. Now let's move to the next concept, two concepts, which is sunk cost and opportunity cost. Sunk cost is nothing but a cost that has already been incurred and that cannot be recovered. So the concept here says that your future decisions should not be based on sunk cost, right? Because that cost is already gone. It is not going to come back, right? So your next decision should not be a function of sunk cost. For example, let's say you have bought a movie ticket for the weekend and the movie had just released, right? And the initial reviews are pathetic, right? It's unbearable. What would you do? Because you already spent, let's say, 500 rupees on a ticket. It is wrong to again just attend, I mean, go watch that movie and torture yourself just because you have spent 500 rupees. The concept of sunk cost says 500 rupees is a sunk cost, right? That should not determine whether you now go and watch that movie or not. Okay. Another example could be you have all opted for this session, right? Of course, there is no fee, but let's say you were to pay, let's say, 500 rupees for attending this session. At any point, if you find this session boring, the best decision would be just to drop off, right? Just because you have paid for that session doesn't mean that you have to sit through it if it is not benefiting you. So what is the counter to that? Now, whether you continue with that commitment or not depends on what is your opportunity cost. In the example of movie, you should ask, if not movie, what else I can do, right? If there is anything better to do, probably you will pursue that, right? So your opportunity cost is the next best alternative, the thing which you had left or lost actually while choosing the first preference. Why this is important is, lot of times you will encounter situations where you will have some sunk cost, but that should not drive your future decisions. You have to be pragmatic and rational in terms of assessing your choices, right? So the key principle is cut your losses early, and this is not only true in terms of investments. This is also true about our relationships, our uh, work culture, and so on, right? If you are in a toxic relationship or a toxic work environment, cut your losses and move on, right? There is no point in lingering on. Of course, this is easy to say and difficult to practice, because we are all uh, a victim of what is called as loss aversion or regret aversion. We do not like losses and we do not like to regret our past decisions, right? So that uh, influences our choices. So a lot of times I've seen that people invest in a particular stock, let's say at 100, then it goes down to 70, and then they keep on betting till it reaches back to 100 when they can sell, right? Because they don't want to lose, and then they justify. So sometimes it is a long term investment is nothing but a short term investment which went wrong, right? And that's how you lock yourself. Okay. Moving on, the next set of concepts: present value, future value, and discounting. So we talked about importance of interest rate. Now, present value is very simple principle, and this is age-old wisdom. This is nothing new. A dollar today is worth more than a dollar tomorrow, right? If you remember Aesop fables and other stories, it says a bird in hand is worth two in the bush. What it means is you prefer certainty over uncertainty. If you feel that there are two birds in bush which are not certain or which are difficult to get, probably you should settle with a bird which is in your hand, right? So that actually determines what is the present value, current utility of any asset or things that you own. Now let me explain why I mean how it works, right? So suppose if I lend you $100 today, and if interest rate is 10%, what was the alternate opportunity I had? Instead of giving it to you, I would have kept that in bank, and that would have become $110. So if 1 year later, if you are returning me 100 back, that is not good enough for me, right? I should demand at least 110. Why? Because I could have earned that by keeping it in bank. So 110 is the future value of 100 after 1 year. Now, if you continue for another 1 year with 10%, that 100 would become 121 in 2 years, right? So this is how future value is calculated. If you flip that in reverse, you can also say that 100 is the present value of 110 1 year from now, or 100 is the present value of 122 2 years from now, right? So that is how these concepts are to be understood. And the process of doing that from FV to PV is called as discounting. Now discounting with corresponding interest rate. That's why interest rates matter. Okay. When you take sum total of it, it becomes net present value. Your objective should always be to earn a higher net present value in today's terms. Okay. A related concept is called as internal rate of return. I'll not spend too much time on this. I'll just mention the significance of it. It is that rate of return which actually makes your investment uh, break even, right? So consider it as a break even point. I'll discuss more about this when I talk about insurance. Okay, but for now, I'll just mention the high level meaning of it. Moving on, the next concept is leverage. Again, a very important concept to understand. Now, leverage means using borrowed money to increase your returns, right? So, for example, in the context of business, if you are borrowing money in the form of debt, loan, that becomes your financial leverage. When we talk about, let's say, any digital platform or fixed capacity of a manufacturing plant, that is again a called form of leverage, which is operating leverage, right? Because with the same capacity, you can produce more to the extent of utilization of that plant. So that concept is called as leverage, and it comes from mechanical engineering, the concept of lever. So let's say if you have an opportunity to earn 10% and then you borrow at 6% and invest in that opportunity, you have actually leveraged low cost fund, which is at 6%, to get excess return, which is 10%, right? Now this sounds very lucrative, but you should understand that leverage is a double-edged sword, right? Because what happens is the 10% which you are investing is expected return, not the actual one, right? It may vary. Whereas 6% return that you have borrowed at is a reality, right? So if this doesn't work out, you will have to pay from your pocket, right? And that can be devastating. Again, Naval Ravikant has phrased it very well. He said that in the age of infinite leverage, the current era where getting a loan is very easy, right? Judgment is the most important skill, because your judgment will tell whether you will actually get that 10% return or not, right? So that uh, is very important. In other words, leverage is a force multiplier. right? So it can actually multiply either on upside or downside. So here is an interesting example about two fast food stalls. Now, since I come from Pune, usually I talk about vada pav stall, but I think given the diverse audience, I think let's consider uh, burger stall, right? So you have two people who decide to start their own fast food stalls, burger stall. Both of them require initial capital of 100 rupees, right? And let's assume that both of them have that capital with them, so they can start their business on their own, right? But let's say the approach they choose are different. So person A chooses to use the entire 100 and start the stall, right? Fast food joint. Now this is kind of a very simplistic income statement, right? So let's try to understand. Don't get bogged down by numbers. I'll just quickly explain. So let's say they earn a revenue of 100 rupees, right? They make and sell burgers and they earn 100 rupees. To prepare all those burgers, they spend 50 rupees, right? Which means 50 rupees is their gross profit. Now, since they have put all their money and there is no loan, there is no interest they have to pay on loan, right? So this becomes zero. So they get to keep the entire profit, which becomes their profit before tax. Now, assuming that the tax rate is 20, they will pay 10 rupees tax, and finally they will have profit after tax of 40 rupees. Okay. I hope everybody is with me till this. Now let's see how person B approaches this, right? So person B again has 100 rupees, but what he does is he puts only 10 rupees of his own. He goes to bank, borrows 90 rupees, remaining 90 rupees, right? Now this 90 rupees comes at a cost, right? So let's say it comes at interest of 10%. Again, he does similar business. So till here it is same. He also earns gross profit. The difference arises here. He will have to pay 9 rupees, that is 10% of 90 as interest, right? And hence his profit before tax will be lower. Again at 20%, he will pay tax, and this will be his profit after tax, 32.8, right? Now, if you compare these two on standalone basis, who is doing better? Obviously, A is doing better because he's earning more profit after tax, right? But what we fail to understand is person B has used only 10% of his equity, right? If this works, right, and if there is enough demand in the market, he can create a franchise, he can create multiple outlets, he can create 9 more outlets using the same model, right? Thereby, his total profit collectively for all 10 stores would be 328, right? When he exhausts his entire 100 rupees of capital, right? So the difference between A and B is with the same capital that A had, he has exhausted everything and earned 40 rupees. This guy has smartly leveraged. What is the leverage ratio here? This is 9 to 1, right? By leveraging, he can earn 328 collectively, right? Now, this sounds very good when you are considering upside, but this hurts very badly when business goes down, right? So, suppose in a situation like COVID, both A and B are forced to keep their food stalls closed for 1 year, right? Person A will not suffer because he has not borrowed anything. He has nothing to pay to any of the lenders, right? Whereas person B, even if the stall is closed, he will have to pay this 9% interest. And if you multiply it for 10 stores, he will have to pay 90 rupees, which means he will be completely wiped out, right? And that's why I said that leverage is a double-edged sword. When it works in your favor, it can give you massive profits, 8 times profit. But when it doesn't work for you, you can be wiped out. Now, what is the significance for us as an individual? Because all this was for businesses. From personal finance perspective, I hope you can see the last line, right? Basically, the businessman is borrowing funds from where? He's borrowing from bank. Now, where does bank get all the funds from? Right? It is based on the deposits that people like you and I make. Right? So, what is bank doing is bank is borrowing funds from you, deposits, and paying you 6% or 7%. They are lending to businesses at 10%. The difference between the two becomes their net interest margin. That is how banks earn their money, right? And then they are smart business people get money from banks at 10% and build their businesses, right? So the learning here is a businessman is using you as a leverage if all your money is kept in bank, right? Because you are not participating in this wealth creation activity. Okay, let's continue with concept of inflation and interest rate, real versus nominal. So inflation is in simple terms is permanent increase in price, right? Which is not reversible. Now nominal interest rate is nothing but simple real interest rate plus inflation. This is technically incorrect. This works for lower rates only. This is approximation, but I think for our kind of rates or discussion, this is a good approximation, right? So for example, if you are getting 6% on a fixed deposit, and if you get to know that inflation is 7%, what is the real interest rate? The real interest rate here would be -1, right? Which means you are actually becoming poorer. Why? Because your costs are increasing at 7%, but you are only getting 6%. So in real terms, this is a negative interest rate. Okay. So that is how you should understand how inflation eats into your wealth creation journey. Now, Government of India actually publishes a lot of data assumptions in their budget. This is from last year's budget. Intentionally, I have not put the recent numbers, which maybe you can look up as an exercise. But last year, Government of India announced that they expected nominal GDP, which is this number, to be 10%, right? 10.1. And inflation was estimated to be about 4.5%, right? Which means the real rate of growth last year estimated was difference between the two. Now you can check what is their estimate in the recent budget which was announced on 1st February, so that you understand this concept more. Now why this is not relevant directly to us, in my opinion, is inflation is very tricky concept and often misunderstood because it is based on a concept called basket of goods. What basket of goods means is based on what government thinks an average household would consume. So they monitor their prices, publish that data, and that becomes your CPI index, right? Consumer inflation index. The issue here is, first of all, this average household is a misnomer, right? There is, it's probably not applicable to you. Second is this reference data or these estimates are not revised frequently. In fact, recently our government revised this base year. Earlier was 2012, now it is 2024. Just I think last week or 2 weeks back they announced this change, that now onwards inflation data will be published based on this as a base year. Now the funny thing is, if you see components of these this inflation index, right? Just see what is the weightage they have given. Food and beverages, earlier it was 45%, now they have brought it down to 36%. Still substantial amount in this category. And you can go on checking the other categories. The interesting part to notice here is they also have pan, tobacco, and intoxicants as a standard component of inflation, which means government kind of acknowledges that everybody consumes this, or I don't know whether this is kind of silent approval of consuming this, right? But that weight is close to 3%. In fact, increased from previous series. Now, why this is irrelevant to us is, if let's say you are spending 50,000 per month as a household expense, according to this you are spending 18,000 on food and beverages, 8,800, which is this component, on housing, utility, and fuel, and then you are spending 3,000 on pan and tobacco, right? It doesn't sound like my kind of expense, right? And probably it is also true for you. So the question here is, what does 7% inflation mean to you, right? And that understanding is very important for understanding our own personal finances. Okay, so you should be able to build your own inflation index. For example, let's say my basket of goods may look like this. I might spend 40% on books, 50% on movies, entertainment, and so on, and only 10% on rest all buckets. Now, if there is a substantial price increase in this, is it going to affect me much? Definitely not, right? So, of course, I took extreme examples just to convey the point, but I hope you understand the thought process. So, basically, do you have an idea of your own basket of goods? Okay, do you keep track of the changes in prices over maybe decades as you grow older, of the core atoms you consume? Okay, and I'll explain why this is important. I have a couple of interesting data points and observations. Can you project or estimate the cost of your own basket of goods, that is your living expenses, in let's say 2045, right? So you should think about these things. Even if you get it wrong, I think the approach is more important. The kind of considerations you do is more important, and that's why relying on an external benchmark, right, reference may not always work. So here I would like to give analogy of ship of Theseus paradox, which is about identity crisis. I'm not sure how many of you are familiar with this, but imagine a ship which is at a dock, at a port. Now you take out all components of that ship and replace with new parts, right? As part of repairing process. What will happen eventually is, hello, any questions? I think someone needs to go on mute, please. Thanks. Yeah. So if you replace all the components of ship one by one, eventually what will happen is you will have a completely new ship, right? Now, whether you call it a new ship or whether you call it as an old ship, and that is the paradox explained here, which is about the true identity crisis. Now, why I'm bringing up this is it is also true about the benchmark that we consider for investment. Now, before that, there are organizations which are, let's say, more than 100 years old, right? The founding team members are probably long gone, right? Their products and services have changed over years. Their customers have probably died and new generation of customers have come in, right? A lot of things have undergone the change. So is it the same organization or is it a new organization? What is the binding force that makes it the same organization through centuries, right? Now some would say that it is culture or other aspects, right? So you have to understand that it is not the same thing which we are referencing in the beginning. Now, in terms of our own discussion, let's consider example of Sensex, which was the uh, BSE 30 stock index in 1986. So, incidentally, 40 years old, right? If you go back and check the constituents of initial Sensex 30, there were 22 companies from core industries. And by core, I mean manufacturing, cement, steel, and those kind of old economy companies, right? There were no banks. There were no IT companies in the index, right? If you see today's composition, the same Sensex, which started from 100 level and now it is at whatever level it is, the same index kept on growing, but the components of that index were very different. So in today's index, we have 5 banks, 4 IT companies, which did not exist at all, 2 financial services, 2 construction, and so on, right? So this is a broader representation of economy as it exists today, right? The point is, If someone says that investing 100 rupees in index at that time becomes so and so, why that is not practically correct is every time you would have to switch and mimic that index, right, with every change, which is not really possible. Only 7 companies from the original index of 30 are still there in the Sensex today out of 30, and their weights have also undergone significant changes, right? So you can see the churn that has occurred in last 4 decades or so. Okay, now another habit or kind of our orientation that affects us in our personal finances is we often want today's income but yesterday's prices, right? This is called as anchoring bias, right? That we are somehow in our head we are wired to stick to a set of regime of prices, and it takes a certain time and effort to come out of the paradigm shift, right? So my father actually passed away recently 1.5 years ago. He was a big movie buff, and we used to watch a lot of movies together in theater, right? But in last few years he was very reluctant to come along with me to theaters. The reason for that was he thought that now the prices of tickets are way too high, right? He was not able to kind of digest those kind of prices. And the main reason for that is he watched movies in this kind of era, right? Diwar, which completed 50 years last year. If you see, uh, the premium ticket price was 4 rupees, right? Today, probably in a similar premium kind of multiplex, it would cost 400 rupees, right? Again, multiple Amitabh Bachchan movies. You can see 4, 6, 7, right? Those were the ticket prices he probably had remembered. And within his lifespan, if price tickets are rising to let's say 300, 400, it becomes difficult to digest, right? For example, standing today, if someone were to tell you that today prices are at 300, but in couple of decades, probably you will have to shell out 9,000 rupees or 10,000 rupees for a movie ticket. It looks absurd, right? But if the trend continues, probably it might be a reality, right? Now there are many parameters which I'm not considering and I'm oversimplifying it, but of course the prices you pay are real, right, which are stuck in your mind. Here is one more example. A famous restaurant in I think Mumbai or Delhi, I don't know. I got it from internet. 1971, two masala dosa and 2 cup of coffee, right? The total bill was just 2 rupees. Another one from 1985, I think a lot of food, just 24 rupees, right? My own personal experiences, and probably you will try to guess my age with that. In mid 90s, when I was just going to junior college, samosa or vada pav used to be 2 rupees, 2.5 rupees. Now it is 20, 25 rupees, right? So that's the price change I have seen in my own lifetime, 10 times and more. And probably it will also happen in your lifetimes, right? So the question is, when you are planning, earlier I asked you about can you project your expenses in 2045, right? Are you able to kind of imagine these kind of price increases for whatever things you are spending on, right? And whether you are able to correctly predict those price hikes. There are only few categories in which prices have actually dropped over the years, right? For example, personal computers or these kind of devices used to be very costly earlier, mobile handsets and so on, they have come down. But that's a rarity, right? Otherwise, the usual trend is the prices only move upwards. Okay. Now, next, let's come to the next important point and very important one, insurance. Important because it's a necessary evil, right? Nobody wants insurance by choice, right? But everybody is kind of forced to have one out of necessity. But there are few things which we need to remember while going for insurance. So insurance is for potential loss of life. I'm talking about life insurance or income, or to cover health related expenses, which is your health insurance, right? Insurance is not meant for investment. Okay, don't consider it as an investment opportunity. Now the problem historically is that, so okay, so before that, why you should not consider it as investments? You do not want return on investment from a pure insurance product, right? I'll explain why. At the same time, you also definitely do not want return of your investment, right? For the obvious reason that you don't want to die, or you don't want to actually get into an accident situation and so on. In short, consider term insurance as a sunk cost, right? It is something that you pay as a token amount just to insure your life for any kind of drastic eventuality, right? Don't consider it as insurance vehicle. Now the problem is that it is hard to digest for us that why should you pay on pay premium and get nothing in return, right? This is one theme which I observe very predominantly in Indian context. For example, for registered investment advice, right? People are willing to pay for multiple things, but they are not willing to pay only for advice, right? Because the notion is that what am I getting return, right? Same is true for term insurance, and that's why it is hard to sell. What insurance companies have come up with is, they come up with insurance linked investment plan, which is ULIP. They combine insurance and investments, right? They will try to lock you in for huge sum of investment every year, let's say for 10 years, 15 years, and they'll give you a lofty sum at the end, which actually is not very big, right? If you consider time value of money. Okay. So if someone offers you these kind of plans, multiple tables and various scenarios, you ask them a simple question, right? What is the internal rate of return of this investment? If you remember, I introduced this concept a few slides earlier. The answer would be not more than 4 or 5%, right? At max equal to the fixed rate of return, right? It is that low. So that's why it is important that you don't mix investment and insurance. You buy a simple term insurance plan early, which is very cheap if you buy it at a age less than 30 or less than 25 and so on, and then focus on investments separately. That would be my advice. Okay, because when you compare that IRR with the other investment opportunities that you have, which is your opportunity cost, you are losing good amount of fortune, right? I have Excel sheets to show that how it works out, but just take my word for it. Okay, the next concept is human capital versus financial capital. Now I often say this, that as middle class or middle income group, again that shows how we label terms, right? Everywhere across the world they use the term middle income group, which is related to the income level, whereas we say class, kind of class hierarchy that we are kind of used to, right? But oftentimes we observe that we are one medical crisis away from bankruptcy, which means if something bad happens in our family, which takes a substantial toll in terms of health related cost or insurance and so on, we find it very difficult to emerge out of that, right? And that's a harsh reality. And for that, you need to have insurance. The question is, how much insurance is enough, right? And the answer is, you can never buy enough insurance actually. Okay, it will come very costly. So the approach should be, consider insurance as a substitute for loss of human capital, which means earning potential of that person if something happens to that person. Okay. Insurance as a hedge of future healthcare cost, which is your healthcare insurance. Right? That is how you should look at these concepts. Now, this is how typically we convert human capital into financial capital. So, what you are seeing here is, when you are very young, let's say early 20s, you are just beginning, all you have is human capital, right? And your financial capital, which is this, is almost zero. Over years, when you keep on working, what you are actually doing is you are spending your human capital, so it is coming down, and your financial capital is growing, right? Remember what I said in the first slide about when you work, you are renting your time, right? That is this graph. You are basically spending your human capital and converting it into financial capital. And at the age of 65, if you are in job, you would probably retire, right? Now the key focus area should be what happens after this. Okay, so after this, there is this phase which you can see here, right hand side. So you have earned your income, you have spent your human capital, and you are at retirement stage. Now there is only drawdown. Now there is only financial capital which you are going to spend most likely, right? And what are the components you'll spend on? There'll be of course core components, which is your basic uh, utilities and so on. You might have some discretionary spending in the early years of retirement, but then thereafter your health care costs will keep on increasing, right? What you have to plan for is for this phase as well, right? If you were to consider the complete financial planning. And probably it might sound pessimistic for most of the attendees who are in their early 20s to even think about anything beyond, let's say, 30. But very soon you will realize that you need to start planning for it, and time is of essence. Okay, so how much is enough, right, in terms of insurance? Uh, Now here is a controversial take. It usually says that life insurance is not necessary for non-earning members of the family. The concept is very simple, that insurance is meant for loss of human capital, which means future earnings. Of course, that might sound insensitive, but at least in principle, from theory perspective, it says that life insurance should be bought for people who are at the risk of losing earning potential. However, everybody in family still needs health insurance, right? So that is mandatory for all your family members. Now, just try to do a Google search or research later on future of healthcare cost, at what speed they are going to increase, right? You saw an earlier example of related to movie tickets and restaurant. You will be surprised that these particular costs probably outpace the other two in future. Okay, so how much insurance is enough? It is very subjective, and it may not be enough at all at any point of time, right? So you have to spend prudently as per your life phase. The rule of thumb is don't spend too much on insurance premium that you don't have sufficient uh, capital left, growth capital for other investment. You can keep on adding the insurance as you progress. Now, let me spend a few minutes on a kind of macro picture, especially particularly about India and comparison with US, which is the theme of financialization of our economy, right? Of savings. So here is one interesting report which says that India is in a multi-decade growth phase. And as the saying goes, rising tide lifts all boats. So basically, everybody is going to benefit. The question is whether you are benefiting more than what your needs are, right? Otherwise, it's a no-brainer that eventually everything will be better if you keep on investing. The reason for that is interest rates will remain low and trend downwards. I showed that in earlier slide. From 14% plus in mid 90s, it has come down to 4 or 5% or 6% levels, and it might trend even lower or stay in the same range. But basically, that disincentivizes you to keep all your money in fixed deposits, right? So you need to find new avenues of capital markets. As I said, financialization of savings is a big theme. So there is very good report from Aditya Birla AMC. It is publicly available. You can read it in detail. But I'll present few important findings from this report, which are which I thought were significant. Right? So there is a clear shift happening from physical or traditional assets to financial assets. Physical or traditional assets are gold, silver, or real estate. Right? So that shift is happening in Indian society, and that's a good sign. So here is one comparison. It's again from that report, 2013 to 2023. Right now, these are various asset classes. These are financial assets. What you are seeing here, equities, cash, and so on. And the last two are physical assets, gold and property. Now see how India trends, right, in these categories. 53% of our investments were in property. Add another 17%, it was almost both put together 70%. 70% of what India saves goes into either property or gold. This was 2013. How it has changed over 10 years in 2023 is marginally lower, which is a good trend, but not as fast as I would expect. Right? If you see, equities is still very low. It has increased, but still very low. Right? So financialization of Indian economy or savings means transition from these two buckets to these buckets over next few years. Right? I'll show you now how US compares on this. Before that, a quick comparison of how returns are and what are the percentage of negative returns. Right? So you'd be surprised that people feel that gold is always a winner, right, or safe bet. Not so. In 100-year period, uh, probably 22 times it will give you negative return. Okay. Now this is how US economy has grown. We are yet to reach 4 billion or so, right? So probably somewhere here, which means we are 40 years behind where they were at that point. From there they have now come here, right? More than 25 trillion. One of the reasons is the asset class mix that they have, right, which we'll see on this slide. Now first is, I hope some of you might have noticed, compared to the earlier graph, one block is missing here, right? Did you notice which one? It is gold, right? So gold as physical assets does not exist or almost negligible in case of US, right? Nobody invests in gold. Okay, they might still invest in gold ETFs, which becomes financial asset, but not in gold as a commodity. Right? Now see their trend again from 1990 to 2020, 30 years trend. 34% in real estate, which has come down slightly to 31%. But look at this number, 22% of their investments or savings go into equities or equity related investments, and that has been increasing. It is now at 35%. And why this is important is when this financialization of economy happens, everything gets a boost because lot of capital is coming into banking system, lot of capital is coming into capital markets, which actually funds lot of startups and many other things happen, right? As opposed to physical assets which are of no productive use mostly. Okay, so I think again, to put two together, what needs to happen is this kind of composition that we have in India should somehow mirror this, right, closer to this, and the sooner it happens the better it is. And there are already signs of this happening, and the momentum will pick up, and that's why this is a no brainer that you should participate in this phenomenon of financialization of uh, economy, which is through market linked financial assets. Right? Don't lock your assets in real estate or gold, right? Because first of all, liquidity is very less. It is not get easy to get out of those quickly, and there is a long gestation period before you can actually realize the returns. Now, if direct equity investment is the best opportunity, but it is also risky. So the best suitable alternative is you can invest via mutual fund and balance the risk. Right? Now, again, mutual funds have done well in the past, but the point is, even within that, there is a large spectrum, right? So here is the data I uh, compiled. If you had done 20-year SIP, systematic investment plan of 10,000 rupees per month, right? Which means probably you would have invested about 24 lakhs over a course of 20 years. That would have become as low as 72 lakhs to as high as 2.17 crores, right? Which means even within this spectrum, there is a huge range. So yes, SIP is no brainer, but again, choosing right kind of investments is also important, which will give you returns like this and not this, right? So what we do as part of advisory is we prepare comprehensive plan, do risk profiling, and suggest goal-based investing into various funds based on themes and other things, right? So that's how you can maximize. So one example, I'll probably go quickly through this section unless you have questions. Maybe I can revisit this in Q&A if there is any question. But you would usually uh, go about goals based investing. You will have planned goals, right? And then you will have some unplanned goals, right? Which you can't predict, but you have to provision for, right? And that's how you go about, and it's a iterative process. It is not one time process. So you start with a plan, you have periodic reviews, and then you change your investment plan based on the life events, or change in priority of your needs, right? So all these are factors which you consider in uh, devising a particular plan. It is called as IPS, investment policy statement. Basically you sit with your financial planner, uh, list down what are your goals, right? Long term, short term, what are the requirements that you have, which are negotiable, which are non negotiable, and so on. And then you have a particular strategy to fulfill that goal, right? And then you keep on reviewing it periodically. So how I do it is, uh, I have a detailed financial planning template. There are a few questions to assess your risk appetite and so on, and then I recommend investment plan and then implement it. Or if you want simple advice on mutual funds, either as SIP or lump sum, I do suitable research and advise on where to invest and when to churn and so on, right? So that's how typically I go about my kind of approach towards advisory. Yeah. So what I do is, and that is where aggregation helps, because rather than each person investing in research and other things, I can do it for on behalf of all, and then I kind of invest in all these resources, be it magazines or these kind of research tools, right? To compare how is the performance of various investments and so on. So here is one case study, right? This is actual example of one of the portfolios I had. If you see, they had very healthy portfolio of mutual funds, 2.16 investment, which had become 5.16 CR over a period of I think 10 years or so, right? And then there was one more portfolio. Now, prima facie, this might seem that this is well. I think there is no need to change. But when you do deep dive, what I realized was, if you consider individual rate of return, there was a huge variance, right? Some of them were actually earning just bare minimum as fixed deposit or slightly more, right? So my obvious recommendation was you should redeem and reinvest those, right? So this is the kind of deep dive one can do on even the apparently well to kind of, I mean, portfolio which is doing well, there are still opportunities to kind of do some rotations and enhance the returns further. Okay. So let's move to the next section. I think the last section, which is about various thoughts and quotes, right? General advice, not necessarily in particular theme, but a few of the pointers which I have listed down, right? So the first important concept is having a margin of safety, which means you should create emergency fund. Now that emergency fund could be equivalent to 3 months of expenses, 6 months or 9 months. It is up to you. uh, Different people have different view on that. What matters is what is your comfort level, right? But definitely you should have emergency fund. Don't start any investment without actually creating some sort of emergency fund. Now that emergency fund has to be liquid, so it can be in the form of cash, savings deposit, fixed deposit, and so on. It cannot be in the form of real estate, right? Because you cannot quickly liquidate it. Then try to guard yourself against temptations. The reason I'm saying this is, now there are a lot of apps and other things, right, which you constantly nudge you into buying things. They are trying to change your habits, right? You have lightning deals, festive offers, and so on, right? In fact, one person jokingly said the best way to save during, let's say, Diwali, these offer deals, right, is not on Amazon or Flipkart. It is by deleting those two apps, right? Because that's when you'll have the maximum saving. Remember that if something is costing $1,000 and you are paying only 750 for it and you buy it, assuming that you actually did not need it, you have not saved 250, you have spent 750, right? So the question is, do you really need it? Why this is important is, it is one of the important disciplines which will help you in the long run. So the way to approach this is, there are two approaches. One approach says that consider income minus expenses equal to savings. So whatever you are getting, you manage your expenses, and whatever is remaining, you save. The second approach, kind of very drastic approach, says think about what you want to save, right? And then remaining amount is what you can spend as expenses. So try to live within these expenses, right? Now both are extremes. The way I do it is, I have mix of both, right? Which is, I have two accounts, right? Let's say my salary or my income comes into first account, and I have some high level view of what my expenses would be. What I do is, I keep only expenses in that account and move the remaining account into my other account, right? Now two things happen. Either I live my within my expenses, or I exceed those expenses. When I exceed those expenses, I borrow from that other account. The way it works is, actually you have certain guilt feel, right? When you constantly are spending more than expenses, you will have some guilt saying that probably your planning is not correct, or you might revise your expenses saying that I think this has to be relooked at, and then I don't have enough savings possible, right? Either ways, it becomes a good disciplinary habit. At least it has worked well for me. The next important advice is, don't count your home, the one you are living in, as part of your assets or net worth. The reason is, you are never going to sell that home and monetize it, right? Even if you sell it for some reason, most likely you'll end up buying similar one, because you usually don't compromise with your uh, style of living, right? So don't count it as your asset, because it gives you false sense of comfort. So if your home is not asset, then what is it, right? If you have completely paid for your home, then it becomes your equity, right? Or most likely it will be a liability, because you must have taken huge home loan for that, right? So you are basically paying for a liability. Higher the home loan, higher the EMIs, which means lower the investable surplus or growth capital, right? So one suggestion I give to young people is don't try to stretch yourself too far and try to buy huge home right at early age, because what then happens is you spend most of your career just repaying the EMIs, right? Let your home be a replica or reflection of your progress in your career. So maybe start with a lower sized house. As you become wealthy or as you progress, you can upgrade that, maybe buy a new one, right? Because if you are spending too much of money on EMI, you are starving yourself of the growth capital, which you would want to invest. So there is a very good book, Rich Dad Poor Dad, and the key theme of that book is poor people buy liabilities, rich people buy assets, right? So consider this, right? You have bought a huge home on home loan. Actually, you have bought liability because, as I said, you cannot monetize it. You are living in it. So that's where your main growth capital is locked. Typical rule of thumb is your home loan or mortgage payments should not exceed more than 30% of your post tax salary, right? Or less than that if possible. One more point is time in the market is far more important than timing the market, right? Don't try to time the market, just stay in the market. As we started this session with, the compound effect, the long trajectory will take care of all the ups and downs. Eventually it will work in your favor, right? Don't try to outsmart the market in general. Now, personal finance is more of habits and processes than timing and intelligence, right? Why I say this is you should focus more on process rather than process, the outcomes, right? And this is in line with what we also have advised in, let's say, Bhagavad Gita, right? Which says just कर्म करते रहो, फल की अपेक्षा मत करो, right? Which means you focus on the process, the outcome will follow. Stick to the process, stick to the system. Those who have read a book called Atomic Habits, actually there is a slight tweak of this particular thought in that, but basic thought is this: you do not rise to the level of your goals, you fall to the level of your systems. So make sure that your systems are very reliable and very robust, right? Don't try to aim for lofty goals because something might go wrong. Feedback loop is very important. Investment process is not cast in stone. It is not that you create a plan and then it's done, right? Develop a habit of saving, investing, planning your goals and reviewing it every quarter, right? You may not change it, but develop a habit of reviewing it. Keep learning and also seek advice. It is not optional, right? Both are equally important. Now this is something very important, especially in today's world of financial influencers and uh, Instagram influencers and so on, right? Do not blindly trust the data, right? Numbers are often not reliable or directly applicable to you, as we discussed in case of inflation, right? In fact, uh, this happens with government of India as well. They also change certain numbers retrospectively. They would change the inflation data or GDP data or even tax laws, right, retrospectively. So there was a very interesting quote by former RBI governor, which said, everywhere in the world the future is uncertain, in India even the past is uncertain, right? And this is actually true, right? Lot of times if you rely on a particular inflation data, they might revise it, right, retrospectively. Again, in today's world we have information overload. Don't accept everything online as truth or facts, right? uh, you can take advice from Abraham Lincoln if you want, right? You'll find all sorts of these kind of pictures and messages, right, floating on, and nobody actually pays attention. They just keep on forwarding without even doing the basic checks, right? So don't do that. Take a informed view on whatever you are consuming. Okay. Now, in terms of personalities or books, I would just suggest few names which you can follow. Of course, there are many, but these are the ones I follow and I found them sensible, uh, be it books or podcast and so on. Okay. I also have other courses. For example, one was value creation, valuation, and so on. So if anybody is interested, I can uh, conduct that session as well. Right. So finally, to sum up, start your investing journey as early as possible, and remember, the best time to plant a tree is 20 years ago, and the second best time is today. Right. So if you at no point you are late, the right time to start is now. Okay. So that's all from my side. I hope this was useful and informative to you. Over to you.
Thank you so much, sir, for that incredible, insightful session, actually. You've helped us understand a little more about finance and its clarity and also consistency, which is important. And as you just rightly mentioned right now, the second best time is to start right now, even though the past is done. I'm sure many of us are already thinking about investing, like some funds, and maybe reconsidering a few impulsive purchases too here and there. So thank you so much for that. As we move forward, the floor is now open for Q&A. Please feel free to raise your hands or drop your questions in the chat. No question is too basic because if you're wondering about it, chances are someone else is too. Um, yes, there's someone else. There's someone raising their hand. Yes, Ayushi, please go ahead.
Good evening, sir. It was a really helpful session.
Thanks.
So I wanted to ask, like, how you said that you should make your own financial goals and start investing and first make an emergency fund also.
Hmm.
I'm currently 19 years old, and I wanted to know the idea about like how to make your financial goals because अभी it is feeling like कि जितना भी आ जाए उतना अच्छा है. So what
Correct.
is the correct goal you should ideate for and how to differentiate between what is your necessity and what is the greed here? Like am I just putting a random number this much I want or is it my greed that I want more money?
Yeah. No, good question. I think when you are just starting your career, right, your aspirations are actually far more than the income that you have, right? So you want to do so much with whatever uh, basic you have that you probably are constrained by choices, right? Now there is not easy answer to this. I think my suggestion would be start with and that's why I said that process is more important than the outcome. The fact that you are having all these questions means that you are on the right path, right? At least you are thinking about it, because I would imagine that probably other people would not even think about this question, and the first thing they would do is get an iPhone on EMI, right? Which probably locks them for 3 years or 5 years. So the best way to think about it is start with smaller time horizons. You don't have to think about maybe 60 years old version of yourself right now, right? But maybe 3 to 5 years, what are your priorities? It could be higher studies, it could be settling in life and so on. uh, Prioritize those, right, and try to set investment plan around those goals. But trust me, in this age, your goals itself would change very quickly, every, not if not 6 months, every 2 years, right? So keep that in mind, that the short cycles have to be very short for someone at your age. But I think your thinking is right, that you are at least aware of what needs to be done. Did I answer your question?
Yes, sir.
Yeah, thank you, Ayushi. Next, we have Shubham. Yes, please go ahead with your question.
Hello, hello. Very good evening, sir. It was a great session.
Yeah, thank you.
So my question is that so how should we allocate like the different asset classes? So how should we plan the allocation? Because at this stage
Yeah.
we can be So it should be all on equity or should be diversify our portfolios. So that's what my concern is.
Yeah.
And should be should be like there are many mutual funds. We get confused at which sector, which mutual fund to we should invest in. Like it's always large cap, multi cap, or like hybrid. So that's my question is because even I'm investing, but I'm a bit confused that should buy because there are different multi allocation fund. There are different funds happening. So
Yeah.
there is thematic fund as well.
Yeah.
And nowadays people talks about this gold ETF and silver ETF since 1 year. So that's my question: that how should we look into it once, and what the research we should do before putting any funds or money in the those
Yeah.
asset.
Okay. So on your first question, yeah, asset allocation is very important. Don't put all eggs in your one basket, right? As the wisdom goes. Now there are some rules of thumb. Again, nothing prescriptive here, but some people say that 100 or 110 minus your age should be in your equity, which means that in the early part of your lifespan, you can take more risk and hence more exposure to equity. That can be through direct equity or it can be passively through mutual funds, right? But rather than investing in fixed deposit, have more exposure to equity. The reason is you have a longer lifespan for taking risk. As you grow older, for someone, let's say, reaching retirement age, it is not wise to put everything in equity, right? So that's when they need to diversify. Now one particular important insight, my personal one is, asset allocation is very important, right? So when I started investing, the very first investment I made in stock gave me return, uh, I mean double the return, double the money in less than 30 days, right? Till that, that is my best investment return. Unfortunately, I had invested only 2000 rupees in that, right? So you will see this transition, that initial focus is on selecting the right investment, right? Picking the right security or right fund and so on. But later on you will realize that asset allocation is more important, right? How much you are putting in your winners, whereas how much limited you are putting in your losers is what ultimately will decide, right? So start with that approach. Initially you can take risk, so be open to investing more in equity or equity linked investment products and less into debt or fixed deposit. Your second question was about, sorry, oh, choosing the funds, right? Yeah. So
Yeah.
yeah, so that is one valid concern. See, in India we have more than, I think, 2,500 mutual funds, right? Mutual fund schemes, right? And a lot of them have this fancy name, hybrid and balanced and so on, right? Basically these are all investment themes, and that's where research comes into picture. When you approach some advisor, so what we do is, for example, you have two investment funds, right? Mutual funds. There are tools which compare what are the holdings of these two funds. What happens is, if you find one too risky, you might switch into other, only to realize that they are also in turn investing in the same stocks. Now that is not a diversification in true sense, right? So that little bit of research is required. Secondly, these themes are also very important, right? Now you have sectoral funds, so you need to have a view, right? For example, the recent view is whether IT industry is a right sector or not to invest, right? Given that all the technology churning is happening, right? If you have these views, you can bet on that. You can select sectoral fund. Otherwise, go for more generic ones, broader investment funds, right? Which is balanced investment fund or flexi cap fund and those kind of things. But yeah, I think that's where I think you will mature as an investor by your own research or taking some advice and learning from it.
Yeah. Thank you, Shubham. I hope you got the answers for the question you were asking for. Moving forward, floor is still open. If anyone wants to ask questions, you can just unmute yourself, or you can go ahead and put it on the chat box, and I'll read it out for you guys. Since we're waiting for the questions, I have my question I want to ask.
Yeah, please.
Firstly, I've been recently started my SIP journey. So I did get a lot of advice from my coworkers who's been I've been investing for the past 4 to 5 years now, and then from that is when I started my entire SIP's journey. Now that I'm looking forward to it, and it's just been like barely a few months which I've started. What should I focus on more in the first few years is what I want to know. Like maybe the returns I get or the consistency. Though, like it sometimes gets like I keep invest like for the past 3 months as well. Even though it's not a big sum of money I've invested, it's still a quite a it's a nice number. So when I'm looking back, I do not want to feel like wait, it just keeps going. Like I just keep pushing it and nothing's happening, right? Because SIP is like that. So I just wanted to know how do I keep myself consistent like that and thinking like no, it's actually going to work out.
Yeah.
Yeah, that's
So
my
I
question.
think my basic advice would be try to learn about the thing you have invested in, right? So for example, if you have invested in two funds,
Mm-hmm.
try to understand what those funds constitute, because ultimately these funds invest in some companies, right? Some stocks, and all that information is publicly available. The the problem is that we never take that interest to deep dive and see what is their exposure to, let's say, IT industry, what is their exposure to, let's say, sectors or industries, for example, which are now affected by tariffs, right? So see, concept of mutual fund is you have delegated responsibility of money management to a money advisor. The difference between individual money advisor, which is like a investment advisor or a PMS, portfolio management, and mutual fund advisor, is that you are just not appointing him specifically, you are choosing a fund. So he is not necessarily acting in your best interest, right? He is not trying to maximize your goals, he is trying to maximize overall goal of that fund, right? So in that case, what happens is responsibility of how much money you put in it when you exit, it's still your onus, right? And that's why it becomes a bit tricky. But the simplest way would be try to take interest in where you are already invested, try to learn more about it, the fund manager, the fund performance with respect to its closest peers, and so on, right? And over a period you will develop that understanding. I hope that answers your question.
Yes, thank you so much. We have a few questions in the box. First thing is in between FT and SIP, which one do you suggest the most for investment?
So FD is kind of dead investment, right? I mean, see, the only investment which continuously grows in value is actually fixed deposit, right? Because you know the starting point, you know the end point. At any given time, you know how the trajectory is. The problem is that the trajectory is very flat, right? The good side to it is there is very less risk, right? Whereas the other investments through SIP, if it is a equity fund, will be fluctuating, right? It will have its highs and lows, but the fact that it has higher potential is the attractive part of it, right? So I think the question should be not whether SIP in equities or fixed deposit. The question should be, if I have 100 rupees to invest, how much goes into this asset class and how much goes into this asset class, and how do I monitor that and switch that or churn that as it, I mean, it gives results.
I hope that answers your question. Moving forward, we have one last question we'll be taking in for the session. How do I practice stock analysis without risking real money?
There is, I mean, the simple answer is you cannot do it, right? The concept of equity is you are taking risk, right? You are owning part of the business. When you are owning part of the business, you should be open for all possible outcomes, right? And that's why equity is the most risky form of investment, but it also has huge potential, right? So don't shy away from taking risk. The point is how much exposure you should have when you are not controlling or running that business, and how you should monitor the progress of it. One problem in India that I see from equity perspective, right? It's uh, compared to US or other things, we have still very poor corporate governance. What it means is, imagine a case like Satyam Computers, right? A few years back, it was kind of a top leading IT company, but suddenly it came to light that they were cooking their books, revenue was fudged, and so on, right? So corporate governance is a big risk still in India because our regulatory compliances, the disclosure norms and other things are still weak. Because of that, what is happening is, just to give you statistics, we have more than I think 5,000 listed companies in stock exchange, more than 5,000, right? The actively traded ones, which have significant buy and sell activity every day, are probably less than 500, right? Even within that, the chosen few, less than 200, actually get substantial investment. So what is happening is, too much of good money is chasing too few companies because those are considered not as a safe investment but more reliable investment from corporate governance point of view. So that risk is there in India. The scenario is changing but very slowly. But yeah, I think that is one risk in equity investment, that uh, the company may go bankrupt and so on.
Yeah, I hope that answers your question. So, thank you for your thoughtful questions, and thank you, sir, for answering them with such
Thank
clarity
you.
and patience. Um, as we conclude, here's something I'd love for all of us to remember as we end this session. Financial freedom isn't about earning crores overnight. It's about smart decisions made consistently over time. And today we've taken one of those smart steps without even checking our bank balance first. That's growth already. Um, so, on behalf of Rotary Club of Bengaluru HSR, I extend our heartfelt gratitude to Mr. Kaustubh Agashe for sharing his time, knowledge, and insights with us. To all our collaborating clubs and fellow Rotaract members, thank you for showing up and choosing to invest in yourselves. That truly is the biggest kind of investment. As we are ending this entire session, I would like all of y'all to please turn on your camera. We'll just take a nice group photo. Yeah, thank you for the
Thank you all. Yeah, thank you
photo.
for giving me the opportunity.
Yeah, and I'll be actually dropping the feedback form in the chat box right now. Please feel free to drop in your information on how you like the entire session. If you have any feedbacks moving forward as well, we'd love to hear it from you. And yeah, this is Rotractor Dwani. Thank you for the evening. Wishing you a disciplined budgets, growing portfolios, and fewer where did my money go moments. Thank you and have a wonderful night.
Thank you.